today. But let's go ahead and get started. I'm going to go ahead and say post in the chat, get this disclaimer up and rolling. I've got some furniture in here now, so hopefully before too long, it turns into not in a room full of echoing. So pretty optimistic about that, but otherwise, I would say all is well. We've had a fantastic week. We've closed on several properties, and we're closing on one more later today. Let's see. So this week we've closed on 4 properties, and we're closing on one more today. Now, we normally only close on Fridays, but we decided to mix it up a little bit, and we are closing on this week we closed 1 on Monday, 2 on Wednesday, 1 yesterday, and 1 today. So I gotta say, I don't really like it, but certain circumstances called that we close sooner than later. So we did that, and today we'll be closing on just 1 rather than all 5 of them today, which is fine. Let's see. We've had a decent week though. Let me see how many properties we currently have under contract. We currently have 35. We currently have 35 properties under contract. Part of that is a package. We're going to close on 11 of these next Friday. So that probably makes up the bulk of it. So without that package of 11 properties, we would have 24 under contract, which is a little bit more normal than us having 35 properties under contract. But things are going well. Let's see here. So far, we've closed on 57 properties this year. As you probably remember, our goal is to close on 200 properties this year. So at 57, we're not too far off. So as soon as May starts, so we're supposed to be closing on 17 properties per month. So 17 times 5. By the end of May, we need to have 85 properties that we have purchased, which is surreal. It's still wild to say out loud. So if you take the 57 that we have under contract and then the 57 that we've already purchased, plus the 35 that we have under contract, that would be 92. So if we can get everything that we currently have under contract closed by the end of May, then we'll be on target. We're also currently walking through 2 refinances. One is a refinance of, I think it's 11 properties. And then another refinance that we're currently working through is of 48 properties, I believe. So those 2 refinances will free up about $4 million that we'll be able to go out and then use to redeploy or purchase additional properties. And, here on average, we've been borrowing or spending right around $1 million per month on acquiring properties. So if this one refinance frees up $4 million, then that will pretty much fund about 4 months worth of acquisitions for us. We might be able to deploy that money a little bit faster. We should. Our private lenders will definitely want us to deploy that money faster. So in that case, that would jumpstart and allow us to probably get over that 100 mark pretty quick order. So that would give us a decent head start on finishing the year with 200. Let's see, I can actually tell you how much we've spent per month. So in January so far this year, early in January, we deployed a little bit more than $1 million. Nope, I'm looking at the wrong number. There we go. So in January, we spent $775,000. In February, we spent 1.03 million. In March, we spent 915, and so far in April, we're at 1.14 million. Absolutely surreal. So far this month in April, we have purchased 18 homes. And this is the first time that we have purchased more than 17. This is actually the first time that we have hit our target of buying 17 properties in 1 month. So let's go through that again. In January, we purchased 11. In February, we purchased 15. In March, we purchased 13. And here in April, we are at 18. And then with us closing that package of 11 properties the first week of May, that will give us a fantastic head start on reaching that 17 mark for May. So again, it's super surreal. And, 18 properties is more. So we've purchased 18. And for the most part, that is really close to more properties than we purchased in the first 2 years of us doing business. So in 2017, we ended the year with 2 doors. 2018, we ended the year with 21. And the only reason we ended 2018 with 21 is because we closed on a package of 13 properties. So otherwise it would have been 8, which is a little bit more realistic or reasonable, it seems, but ended 2018 with 21. And then today we're closing on another one. So that would put us at 19. So we're just 2 away from more properties than we had in the first 24 months of us doing business. We ended 2019 with 38 doors. And then we ended 2020 with 84, I believe. 80 or 84. So by the end of next month, we will have acquired more this year than our first 4 doing business. We ended 2021 with 200 doors, and now in 2022, we currently have a little over 250. Super stoked. Super stoked. Runner Gunner, good morning. What's up, King? How can I be a private lender? Sign me up. Hey, man, shoot me an email. We will talk. Happy your crypto gains are staying steady for you. Happy Friday. Nora Stocks, what is up? Let's see what I can learn today. That's what I like to hear. They say that how much you learn has everything to do with the quality of questions that you ask. So, I'm going to turn it back on you. Are there any ways to get lower down payment percentages as an investor in the state of Ohio? Are there ways to get lower down payment percentages as an investor in the state of Ohio? I think so. So I guess let's talk about all of down payments real quick. So if you are an owner occupant, then generally you can get into a property for 5% down, maybe less if it's your first time, if you're a first time home buyer, or if you have some sort of like grant or governmental program helping you out. So if you're interested in doing that thing called house hacking or buying like a multifamily property, because if you purchase 4 units or less, then it qualifies for the same loan, the same residential loan. So in theory, you can live in one of the units of that 4 unit. You can put 5% down or maybe less and buy that 4 unit. You could rent out the other 3 units, maybe even the other rooms inside the unit that you're going to own or occupy. That would probably be the easiest way to get your first property without putting much down at all. Other than that, traditionally, if it is an investment property, then most banks will want you to put 25% down. Now, 25% down is a kind of a good rule of thumb. However, if you're not opposed to paying PMI, private mortgage insurance, then there are some local credit unions here in Ohio that will only require that you put about 15% down on an investment property. However, you would have like a monthly PMI payment that really, does you no good. I think it's like $50, maybe more. I think the PMI, the amount that you pay on a monthly basis, has everything to do with the value of the home. So if you just do a traditional loan, then you're looking at putting 15 to 25% down. Now, the last way to kind of put no money down, which is what my brother and I do, and that is that you use private lenders or your own cash to purchase and acquire a property. Acquire and renovate. So purchase and rehab a property. Now, if you do that, then you're using your own capital or the money of a private lender, and private lenders do not have the same stipulations as the lenders do, right? So while private lenders act as banks, they are not banks. Private lenders can be friends. Private lenders can be family members. Private lenders can be, institutions. And when you're operating in this space, the terms are whatever the two parties kind of mutually agree on. So what we regularly do is we use private lender money to acquire and renovate a property. Now, as we are purchasing these properties, we are paying very close attention to make sure that our purchase price plus the renovation costs are not greater than 75% of the loan to value. Because banks generally want you to put down 25% down and they want to give you 75% loan to value on the property, that is why we are saying we want the purchase price plus the renovation costs to be less than 75%. So if we purchase the property, renovate the property, and then get that property rented out for less than 75% of the after repair value, then now, once that property is seasoned, which every bank has different seasoning requirements, you can take that recently renovated property to the lender and you could do a cash out refinance or just like a rate and term refinance. I want to stress that every bank has their own individual rules and preferences of doing this. So if you get rejected by one lender or if one lender turns you down, you should look at all of the other ones. Don't take your first response, especially if it's negative, at heart. That's not how all banks operate. That's just how this bank operates. So then, in a perfect world, all the deals that we do, the money received from the lender at 75% loan to value will pay off that private lender. And then hopefully there's a little bit left over. Hopefully we ended up less than that 75% and we're able to pull some cash out of the property. So that is our goal. And if you do it that way, then you never have to put any money down because you borrowed 100% of the purchase price and 100% of the rehab costs. And if you can get pretty good at doing that, then you will never have to leave money in a property. And if you never have to leave money in a property, then there's no limit on how quickly you can scale, other than just like the natural bandwidths and bottlenecks of running a business, which are plenty. And I think one of the most important things that you can do as a real estate investor, as a business owner, are constantly searching and assessing for your potential bottlenecks, any sort of bandwidth issues you're having, or anything like that. So, good morning. I'm in contract on my first home. Would I have trouble getting into a second investment property? Would your advice be the same on yesterday's video? Let me see. I don't hear an echo at all this morning. Nice. Thanks, Mom. I don't think you're going to have any trouble getting into a second property depending on how you do it. So, there are different strategies for getting started in real estate investing. If you are a bankable individual, if you have a strong W-2, if you are able to qualify on your personal name, your personal income, then there's really no limits. Like a good friend of mine has a high W-2. He's a high W-2 income earner. Him and his wife are rapidly utilizing their like 10 Fannie Freddie loans that they have available to them. And they are able to qualify for these loans based on their income alone. So you personally being able to qualify for a second rental property shortly thereafter buying your first likely won't be an issue. Now, the closer you get to that bank's allowable debt to income, the harder it's going to be. So for the most part, I think it's my understanding as soon as Will moves up here, he'll be able to rattle this stuff off since he is a lender on the residential side and now soon to be on the commercial side as well. He'll be able to answer these questions a lot more efficiently than I am. But for the most part, I believe that the traditional banks will consider real estate investments to kind of be like a new business venture. So if you are a self-employed person, you have to be in that industry being self-employed for about 2 years before you are bankable. Similarly, banks want to see that you have been the owner of rental properties for about 2 years before they count the rental income as income on your debt to income calculations. So sometimes people get a little bit trapped because the mortgage payment on their first property is now included in their debt to income calculations and the rent is not. So the rent isn't being counted to offset that debt to income. So Runner Gunner, a good friend of mine, is editing these videos and posting them as people ask questions. So I got to be honest, I don't know. So I see it's a 1 minute and 41 second. I'm not quite sure what that advice was. So I don't know if it's consistent with the yesterday's video. But I would say that as far as building a real estate portfolio goes, then I think it is of most importance to get to 10 as quickly as possible. I don't think that I would be interested in having a portfolio of less than 10 properties. From my perspective, I don't know how you could make money. And I think if you have less than 10 properties, if you have 1, 2, 3, I think for the most part, you're always going to be losing money. Because if you write out, so if you take all of the components of one rental property, like windows, the roof, water heater, the electrical system, the driveway, the exterior, and you take the cost of replacing it and like divide that by its estimated number of months of like its life expectancy, then that's how much money you're going to have to set aside on a monthly basis so that when you need to replace that thing, you have enough money there to do it. If you take all of those items and calculate how much money you need to set aside on a monthly basis, you are never going to be able to charge enough rent to pay for all of those items as they're due, if that makes sense. So for like every 50 years of a property's life, you've pretty much replaced everything in that property if you are sustaining it. So it's very comparable to insurance companies and their the way that insurance companies make money. So, there's not enough premium that an insurance company could charge one vehicle owner if they only wrote insurance on that one vehicle. Because let's say that car, total itself, its damage plus the other car involved is like 70 grand, not to mention any of the liability factors. So it's pretty impossible. And it would be very unaffordable for that one person to be able to afford to pay the premiums to that insurance company to cover all of the things that could potentially go wrong with that vehicle and all the liability exposure that it has. However, if that insurance company writes the insurance for thousands of vehicles, then now statistically speaking, not each and every one of those vehicles are going to be involved in an accident or have a liability suit attached to it in any 1 year, right? So the premiums collected from all of the vehicles insured are sufficient to sustain those insured vehicles and the liability exposure. Rental properties are truly no different. From one property, you can't collect enough money to insulate yourself from all of the things that could potentially go wrong. However, in quantity, you are able to sustain a portfolio because statistically speaking, not all of these properties are going to need something all at once. Right now, if all of our roofs need to be replaced at the exact same time and an insurable event was not the reason for it, if it's just normal wear and tear, it would bankrupt our whole operation, right? I'm guessing. Maybe not. Maybe we could work with a roofer or two or five and get a real quantity discount, right? But, I use that example just to kind of prove a point of if everything happened at once, it would really hurt. So maybe I'm a little bit extreme. The more I'm thinking about it, the more creative ways I'm coming up that we can handle that appropriately. Wouldn't be pretty. There'd be a lot of tarps involved. All analogies break down at a point, I guess all the examples I could possibly come up with would break down to power in numbers is my whole point. Law of averages, law of large numbers. I really don't know which one is appropriate, but that's the idea. That's the idea that I'm trying to convey. Good morning. Happy you joined us. Sorry I didn't alert you last week. I saw your comment, but hey, I'm happy you're here now. Yesterday's video touched on the 2-year required limit to show income through investment property, so the advice is the same. Look at that, man. I'm consistent. I'm a real one-trick pony. All I know is how to invest in single-family homes. If you want to talk about 4 units or more, I'm out of my league. If you want to talk about any other type of investments, out of my league. Single-family homes, I've got the same opinion day over day. Let's see. Let me go do this. Post questions in the chat. We got 8 people on, 22 minutes in. Pretty solid. Let me pull up my list of questions. Man, I've done so many videos lately talking about investing your retirement into real estate. And I really don't think, I know that I'm a little old fella and my opinion doesn't count for much, but I think if I were to give like one piece of advice to, if I were able to give like one piece of advice to all of America at the same time, then it would be, take positive ownership of your retirement investments. Stop investing in the stock market, things that have very little to do with you, your community, things that if they start going south, there's nothing that you can step in to intervene. I would say get out from a local perspective and find small businesses, find real estate investors, find community movements that you want to be a part of that will better the lungible area that you live around, where you have the ability, if you make an investment and it starts going south, that you're able to somehow intervene and help, right? Banks are not kind to small business owners. It is really difficult to get lending, to get the appropriate funding from banks. So you can utilize your retirement funds make loans to these small business owners, to these smaller real estate investors, people that you believe in, people that you know, people that you trust, and you could have a positive impact on your community by empowering that small business owner, by empowering that local real estate investor. And that way, our entire country isn't taken over by these monstrous companies that are fueled by Wall Street, as there have been tons of successful salespeople that have pitched all these 401ks and company sponsored and government sponsored retirement vehicles, right? Let's utilize the self-directed versions of those where you actually have checkbook authority, where you can direct your investments. Take a little bit of positive ownership. Don't leave your retirement funds in the hands of Wall Street, people that you have never met, people that fundamentally cannot have your best interest, your family's best interest at heart, right? So take control of that, invest locally, invest in things that you can kind of hedge yourself against, because you'll be able to intervene. You'll be able to help the small business owner brainstorm, get creative, find solutions in the event that they start struggling. You'll be able to actually be left with an asset in the event that that local real estate investor defaults, right? If your investments in the stock market go south, you're not left with any asset, any real recourse. You're going to have your financial advisor look at you and say, hey, that's the market. You knew the risk as you were getting into it, right? If you invest with a local real estate investor, somebody that is actively working to fix up your community, to provide your community with things that it needs to increase and better the experience of living in that area, and you do a first position mortgage, well, in the event that that real estate investor messes up, defaults, you are left with that underlying asset. You're not left with a bunch of empty sorries, right? So at the rate that we are currently going, at one point, I think, Wall Street, the way that they have access to capital, the way that inflation is going, the way that interest rates are correcting, I think the gap between larger companies and small startups are going to get insurmountable in any of the industries that don't have massive multiples. So right now, if you're a startup and you want to be a kind of overnight success, then the trades are not what you're going to go in, right? It's going to be more of the tech software side of things. Those are the companies that have the biggest multiple. So got to protect the soil that we love. Starts in our backyard. My current goal is to get 10 properties ASAP. I'm a bit nervous because it is go time now that I'm under contract. My money is in there and it's nerve-wracking. It is, and it will be. And I would still kind of categorize where I'm at currently as very nerve-wracking, right? It's thrilling. I'm having the time of my life. I would never want to do anything else, but I still get nervous, right? I put a property under contract yesterday, and I called 3, maybe 4 people to talk about it because I am so nervous about it. Over the 30, 40-year period, yes, it's the right decision. Probably over the 12, 24 month, it is the right decision, but it is atypical. It's an atypical deal for us, right? The purchase price is $95,000 and it still needs like $30,000, $40,000 worth of work. That is not a typical deal for us. That's a lot of money moving in one direction, out before anything starts coming back. So it's not like it gets any easier, right? And I think that's part of the thrill of it. I mean, I would kind of compare it to an athletic event, right? Whether it's your first time playing a sport or whether you are a professional, you will probably still have the same level of nerves going into it. Perhaps more prepared, perhaps a little bit more confident, but nonetheless, those butterflies, those nerves are there. So I'm happy that those are there for you. And now the only thing that you need to do, which unlike the investments that you can make in the stock market, you now have the ability to wake up and work as hard as you possibly can to protect your investment on a daily basis, right? You have the ability to intervene if things get tough. If it looks like you are going to lose money on a deal, guess you have the ability to watch some YouTube videos and try and do a certain task yourself rather than hiring it out, right? You've got the ability to utilize your peer network to figure out if somebody in your network has experience in fixing these types of issues. And maybe they'll let you cash in a favor and, circumvent the big bill once or twice. That's not something that I would regularly do, but as you're starting out, as you are nervous, as you are working your way through this arena, then that is an option available to you. And that is potentially something that you need to do in the event that things get difficult. I quickly learned the level of unfriendly to the small business from banks this month. I was completely surprised. Yeah, it's not easy, and it's only going to get worse, which is why I think if you're a small little person trying to get started, I think one of the the thing that you could do immediately that has the largest return on investment is to educate yourself on coaching people through like the different options available to them and retirement funds. Like right now, there's the self-directed IRA, self-directed 401k for the small business owners or the self-employed, and they can put the self-directed 401k. Last time I checked, I don't keep up with the limits on these things regularly because it's not my area of expertise. But last I checked, small business owners or self-employed could uh, invest or deposit up to like 40 grand on an annual basis into those accounts. Well, if it's self-directed, then they could immediately take those funds and lend those to Nora stocks on a first position mortgage basis. So they're going to be able to get a return. They're going to have security, that collateral, and they're going to be filling a need in the market for those small business owners and those real estate investors starting out because the banks are not unfriendly. However, I think you're also going to be equally surprised on the back end once you wade through yourself, getting through this first property, renovating it. And once you have a stabilized asset, a rental property that's rented out, you can show the bank a 12-month lease. You can show them that it's in fantastic condition. Then they'll lend to you. They'll probably lend to you pretty easily, right? But in that interim, when you're trying to get it established, you're right. It's not necessarily their cup of tea. It's outside of their appetite. So if you're starting out, even if you have, a friend or a couple of friends with like $10,000, $15,000 each, I mean, I think from my memory, that is about, $30,000 is what you're looking to put into those properties. So those two friends with 15,000, they might not be able to move the needle much on their end with that in the stock market, but with you can give them a sizable return. And for the people that have a smaller amount, I wouldn't necessarily, to your point, the last time, I would not give anybody equity, but you can give people some pretty good returns. So you can give them some bonuses. You can somehow structure when you do a refinance, if there's cash out, they get a piece of that. When it comes to private lending, it's truly whatever two people decide to be mutually beneficial. When it comes to institutions and these banks, they're trying to lend on a large scale. So they really use like this cookie cutter format. But when it comes to private lending, peer-to-peer lending, whatever two people can agree upon, they can put in writing that doesn't break any state or federal laws. I mean, you're good to go. Put a lot of properties under contract yesterday. We put one under contract that is not far from the office, from our new office. I align heavily on your views towards investing in the community. Nice. That's good to hear from a crypto fella. What would be the proper formula on flipping a house? I'm having trouble identifying or commuting to what is a good opportunity on that topic. Um, hmm. Well, the thing about flipping is if you don't need all the money, then mathematically, flipping probably doesn't make sense. So far, my brother and I have sold 2 properties. And both of those, and we're trying to sell a third right now. And all 3 of these, the reason that we want to sell them extends beyond capital. So two of them, the one that we're currently selling and the previous one that we sold, are because it is outside of the area that we prefer to concentrate in. So it's kind of a distraction. It's a little bit away from the rest of our properties. Our people are tied up for like an hour commuting there and back, if anything is needed there. And the first one is because we did not have the ability or the desire to take on that large renovation project. However, from a mathematical perspective, if you have the ability to hold a property, then over the long term period, it makes more sense to do a cash out refinance than it does to sell. Now, for whatever reason, you're not able to do a cash out refinance. If the banks don't want to play with you yet, then perhaps flipping a property makes more sense. If you need quick cash, if you need the most amount of cash, then flipping might make sense. But don't forget about the taxes. I'm going to turn my phone on that super duper hardcore do not disturb, where nobody can get through. This little buzzing is distracting me. Ruben Mendoza, good morning. Do you think we are in a housing bubble? What's your forecast for the housing market in the next 2 years? I don't have a forecast, but I know I'll be buying the properties. If the market continues to increase, I'll continue buying properties. If the market decreases, I will continue buying properties. I think you should leave the forecasting. I think you should leave the speculators to the people sitting on the sidelines that need to justify why they're on the sidelines, right? I don't know a single real estate investor that is actively investing, that holds a portfolio, that has too much concern one way or another as to what the housing market is going to do. At the end of the day, it is wise to be prepared. It is wise to take good deals down when you come across good deals. It is wise to have a healthy reserve. It is wise to have multiple exit strategies. And these are things that you should be doing year round, regardless of the market. So as an individual that I have not yet invested in a downturn, you probably shouldn't listen to me, right? I only seek in this area, I only seek the advice and wisdom afforded by those who had rental properties before 2008 and continue to have properties after 2008. In the event that they had rental properties before 2008 and somehow went bankrupt and have yet to rebuild, then I want to know their story and how not to replicate. But in all of the cases in which I have found those individuals, and again, it's limited, it's not everybody, but there was also some sort of negligence that was involved in their bankruptcy and their lack of rebuilding thereafter, right? So all of the ones that had rental properties before 2008 and also have them after, they are the ones that are going to buy right now. They're continuing to buy rental properties. And in the event of a downturn, they are going to continue buying rental properties. So if this is something that really worries you, I would encourage you to embark on a little bit of a deep dive research project into what caused 2008, who were the people that really lost their shirt, and how did some investors profit off things like 2008. Because the very precarious thing about 2008 is that one hedge fund has built the largest portfolio of single family homes pretty much in history from that crisis, so to speak. So a lot of variables and a lot of personal decisions involved in making it through a downturn. Outlook, mindset, those things are important. The property that I am in contract for is pretty solid and move-in ready. It's a bit dated in areas. What areas do you find market makes the most difference in increasing rent and possible equity? Well, um, that's a really good question. And if whenever we purchase a property that is rent ready, yes, these are the things that we look at. So we look at first, what is the amount that rent will be increased versus the amount that we have to spend, right? That is probably the most important metric. Because if it has a dated but functional bathroom, then is it worth the $5,000 to raise the rent by 25 bucks per month? Probably not. Probably not. Will that and then, after you do that, which is all up to personal preference, right? Then the next thing you'd want to look at is how much is this going to increase the value of the home or impact the appraisal based on how much money it's going to require. And then you have to do the formula. You're only able to pull out 75% of the equity in the house. So if it raises, so let's say, you put $5,000 into a property and it raises the value of the home by $5,000, then the money that you're going to be able to pull back is only 75% of that. You're going to leave 25% of that into the property. So you kind of want to run it by that first. And generally speaking, if the property is dated but functional, and I'm not saying like cracked tile everywhere, right? Like if we walk into a bathroom and it's dated and the tile is perfect, it's just pink, then we will leave it. We might paint it depending on the color and how it goes with the rest of the house, and just from aesthetic purposes. Reglazing things is a real thing. It's not too costly and it's really durable. If it is pink tile and it's cracked everywhere, then yes, we'll be replacing it. So if there is nothing wrong with the things that are dated, and if all the mechanicals and underlying, like if there's no plumbing leaks, if all the plumbing is updated, then generally speaking, it doesn't make sense to spend the money to renovate that. From a rent perspective, from a cost perspective, from an equity perspective, continue to maintain it well. And there's a massive niche of people, myself and my mother included, where we prefer the way that dated things look versus like whatever is in style at the moment. So you will be able to rent it for probably market rate to that right person that loves it, if it's truly okay. We recently, I think I posted this, we recently saved all the original cabinets and the original sink of a property, and it looks really cool. And it is significantly cooler than if we just made it look like every other flip at the moment. So those are my opinion. Also, what would you think is a good number to spend on upgrades would be for a first-time purchaser that's looking to keep the expense low to start? That's a really niche. That's a really niche thing. Marketing to a first-time purchaser that's looking for low expense, and marketing to a turnkey rental property investor is almost the same thing. I don't know. I don't really know how to think about that. And I don't think I would do it. Because again, I think if you're going to do that, then it's probably going to serve you better over any given length of time as a rental property than selling it to a first-time homeowner, right? We're not going with a friend who wanted to stake in our business. Instead, we are taking a different approach. It is very relationship based building. Awesome. We would prove successful. Yeah, that's awesome. More power to you. How did you survive the COVID recession? A bunch of people lost their jobs at one point and couldn't pay rent. How did you handle that? Uh, I watched a short video about Charlie Munger, and he was talking about unemployment, and he said some things that were. I really wish I remember the video, but he was talking about unemployment and how a significant number of people contributed to their own unemployment, and those that wanted to work continued to do so. And I think there's a lot of truth to that, right? So there's also a different in markets. So it's not like our portfolio is in an area where we serve like middle management or kind of like C-level suite people. We serve, uh, for the most part, like entry level employees. So if our average rent is $850, $900, then most it's industry standard to require that people make 3 to 4 times gross, not net, but gross income monthly. So $800, that is $2,400 per month. $900, that's $2,700 per month. So making $2,400 to $2,700 per month for most people isn't that difficult, especially the people, since COVID, a lot of fast food places, uh, even in areas like the Midwest, are paying like $15 per hour. So let's just meet in the middle. $2,500 divided by 15. That's 166 hours divided by 4. It's 41 hours. 41 hours gross per month. Excuse me, 41 hours a week to qualify for one of these properties that we own. And I don't know, man, but ever since COVID happened, like everybody's been hiring. So we really didn't have to do anything. The people that lost their jobs wanted to, they were able to find new jobs very quickly. The people that were problems during this were problems before this. And then another funny thing has happened because certain nonprofits have received a significant amount of money to help people pay their rent that were somehow, quote unquote, inadvertently impacted by COVID. Well, what that has caused is a lot of people purposefully falling behind on their rent so that they qualified for the assistance that's available. So that's interesting in and of itself. Yeah, I'm not worried about a crash. Inflation will continue. If it happens, great. Yeah, and the cool thing about real estate is it is pretty well inflation proof, right? Like, rent raises increase even in times that aren't like heavily inflationary. Taxes increase still, insurance premiums increase still, so rents are always going up. That's kind of hardwired into our currency, is that over time its value will decrease because the printing of it continues. Whereas hard assets, businesses, real estate, so long anything that meets the needs, provides value to society, is pretty well inflation proof because you're able to adjust your prices along with the rate that inflation is increasing. I don't mean to sound harsh. Like I understand that uh, you know some people have fixed incomes. I understand that there are a lot of people that our society depends on: the first responders, the military, the teachers, and they operate in an industry where, the amount of value that they bring to society far surpasses what they're paid, right? But one of the things as I'm learning how money works, like a really cold, hard truth, comes to like the top of my mind, and that's that, like, whether you want to be playing this game or not, you are in this game, right? Like, if you are on a fixed income and you satisfy yourself with that, if you make no attempts to bring in additional income, then your purchasing power is going to lessen and lessen and lessen. So if your goal in retirement is to get a fixed dollar amount that is going to sustain you over the next 30, 40 years, however long you kind of plan to live, which I fundamentally disagree with that style of planning, of financial planning, then the longer you spend executing that, the lower your purchasing power is going to be. Right now in this kind of highly inflationary period that we're in, people are getting wrecked when we got like 15, 17% inflation. Like, that's brutal on a fixed income. Your purchasing power just decreased by 15 to 20%. It's going to get difficult, and ever since our modern currency was kind of created, it's been inflationary. So year over year, if you make no changes, if you don't want to adapt, if you don't want to kind of play this game, then over time, you're going to be hurt the most. The people that are buying real estate, that are building businesses, that are kind of contributing and trying to figure out ways to provide value to society, they're the ones that are kind of protecting themselves from inflation. I've been watching a lot of Charlie Munger, Warren Buffett clips lately. And Warren Buffett was recently talking about gold and silver as being hedges against inflation because it has an element of scarcity to it. And in the event of a downturn, sometimes those prices go up. Warren Buffett was saying that, in his mind, the best hedge against inflation is focusing on increasing your personal income because of the skill set, because of the knowledge that you're going to gain during that. You're going to be able to more effectively provide value to society, which is ultimately what is financially rewarded, right? And I get it. It's a very weird, I don't know, dichotomy, right? Like, in talking about all of this, one of the conversations that happened between my mom and I that I'm really thankful for is she kind of didn't appreciate the way that I was wording some things, and she was completely right. And that, it's a fine line. Like, I'm not, when I'm talking about providing value to society and all of that, in terms of like the economy, the net worth, and all of that, like, it has no bearing on what type of people you are, right? So, like, you can have an extraordinarily high net worth, like, as a mother, as a person, like, from a Christian perspective, you can be a fantastic person and very, very poor or very broke, and you can be a horrible person and very rich. So the quality of individual you are has nothing to do with your like economic status. And I want to be very clear each time I'm talking about providing value to society. And I want to be very clear that this current system really wrecks some really good people that choose not to play this game or that don't know how to play this game. But it's one of those things that whether you want to or not, you're in it. And if you're not planning for it, then when inflation hits like it is this year, last year, and presumably next year, it really puts the most amount of pressure on the people that are not actively playing the game. One of the analogies that I like to say a lot is whenever I started learning about money, I realized, like, the more I learned about money, the more I realized that, it's kind of like our society, like capitalism, is kind of like the game of Monopoly, and most people are like trying to play Yahtzee on top of a Monopoly board. It's not going to work. It's never going to work. And you just got the wrong framework. You've got the wrong ideas. You've got the wrong outlook. And if you were to play the right game, you would probably succeed pretty quickly. I think Dave Ramsey recently said, or whatever, he did like a really large study on like self-made millionaires or millionaires in general. And most of them that set out to become wealthy do so or hit that 7-figure mark inside of 7 years. So once you set out to play that game, you can probably do pretty well inside of 7 years. Little long tangent that was, but I hope it makes sense. I really want to make sure that I'm being precise with words when I speak about these things, because it's an unfortunate thing that happens. Good people get wrecked, and it's sad every time. We recently had a resident pass. He was awesome. We purchased his house a couple of years ago, and he was on a fixed income. And when we purchased the property, he was paying $400 per month. And we purchased this property like 3 or 4 years ago. He had a bunch of cancer. He was on a fixed income. He was about to have one of like his feet operated on or removed. I'm not sure. Anyway, he was like, of the best of people. And we raised his rent at one point to $450. It's extraordinarily below market, right? He recently passed away, and we're turning that property now, and we're going to be able to rent it out for like $900, right? So, we had several long conversations with him, and he was pretty much saying like, if we ever wanted to raise his rent more than $450, then he just wasn't going to be able to do it. So we told him that we wouldn't, but I'm thankful that we were able to extend that opportunity. But it's not like that's scalable. We were able to do that for him, but from a scalable perspective, we couldn't possibly do that for many people, because we were very much so negative on that property. We were losing money between taxes and insurance. I think taxes on that were $2,000 a year. Insurance was somewhere in the $700 range. So that's close to $3,000. What's 3,000 divided by 450? So that's 6 months, 6.67. So 7 months worth of rent just to cover taxes and insurance. Not to mention, anything that ever went wrong with that property, which, it needed some work. So now the rest of those 5 months, $2,000. So any problem that happens on an annual basis of that property, we need to be able to fix for less than $2,000. Which, a roof on that property would be like $8,000. So it's not scalable. And, that's a sad story that happens far too often. I'll stop talking about it. Thanks for letting me say all those things. I'm having trouble getting properties at that 25% discount. I find myself too emotionally involved with the deals and settle for less than that percentage. They're out there, and you're right. I mean, that property that I was talking about that I put in a contract yesterday that I called a bunch of people for, I don't think I got that 25% discount. Maybe over the course of a couple of years of appreciation, some principal pay down, not every deal you can get that, but you definitely want to get it more times than you don't. But also, I mean, if you're buying rent-ready properties that might be dated, you're probably not going to get that 25% discount, right? Sometimes we do, but I would say most of the times when we're getting these, we're going to go in and we immediately have to put in $15,000, $20,000 to the property. So there's a little bit more of a discount that we're getting because of the amount of work required. But if you're buying virtually turnkey properties that might just be dated, I can see why you're not getting that 25% discount. But if you are able to get a 20% discount and you're able to do a cash out refinance and you're able to only leave 5% into the property, then that's not a bad deal. That's like getting some equity into a rental property at the homeowner down payment rate. So I'd be proud of that. That is going to limit how quickly you can scale because you're going to need to leave like a 5% trail in each property. But that is not going to have a negative impact on your financial future if you look at the portfolio that you're building and kind of forecast it out 15, 20 years. It's still a great add to your portfolio. And, the 25% discount, I get it. It's not available in all markets. I listened to Clark Howard yesterday. He was talking about rents. Example, Miami a year ago, 1,800, now 3,000. Yeah. I own a pretty small insurance agency, and the insurance company, one of their marketing representatives came out to the office and we had a really good conversation. And he was just talking about the growth that their insurance company has had. And when I started writing insurance with them, they were around $30 million of annual premium. 2 years ago, before the pandemic, they were at about $53 million of annual premium. And now they just crossed the $70 million of annual premium mark. And I said, wow, like that's some pretty explosive growth, right? Like that's massive. But, he was just like, well, yes, like we're doing great, but also, a lot of that has to do with inflation. So insurance companies are really good at taking on a massive amount of data and statistics and figuring out like the appropriate next steps to do. And I don't know everything about the insurance industry or even much about the insurance industry. And he was saying that they use some sort of like consulting firm to figure out how much they need to raise their coverage amounts to keep up with inflation. Like if you buy a house that's, $500,000, but now inflation is 10%. Well, now you have to cover that house for $550,000 because in the event that a fire happens, it's going to cost at least $550 to get you back to where you were before that covered loss. So, he said that their recommendations as of January 1st of this year was to increase rates or increase the coverages by like 15.5%, which is massive. That's huge. That's going from a $500,000 house to a $575,000 house. And the premiums are obviously going to increase because $575,000 worth of coverage is going to cost more than $500,000. So, yeah, rents are one of those things that increase appropriately to inflation. Insurance is one of those things that increase appropriately to inflation. Taxes are one of those things that increase proportionally to inflation. And I think, for you to be truly insulated from inflation, then you need to be into an industry or the owner of a business that is able to adjust your rates based on inflation. I'm saying so much today. Hi, Ryan. What are some of the key elements to address and verify when considering a property to be rent ready? No leaks. Everything works. You got hot air. You got water. You got electric. Nothing catches fire. Nothing smokes. nothing drips. There's no safety hazards in there. No holes in floors. Yeah, quote unquote rent ready means a lot of different things to a lot of different people, right? So I would say those are the biggest elements. And then from there, people are, the the appropriate thing to do is to discount the rent rate based on the condition aesthetically from the property, right? You should never hand over a property that doesn't have heat or doesn't have running water or that is actively leaking, right? You shouldn't rent those properties out. You should fix those issues before you provide them, right? Just fundamentally, I think most states probably protect those things from a legal perspective, right? So you shouldn't do that. From an aesthetic purpose, somebody might not mind, like if you've got walls that smell like smoke and are tinted from smoke, if you rent that to a smoker, they probably won't mind because they're just going to make it worse during their course of living there, right? So that's a judgment call on your end. If the floors are a little bit scuffed, some people probably don't care because they have a rug that they want to put down right over that scuff, right? So we really focus on providing above average housing. So we generally kind of go above and beyond. I put down new flooring, paint. I put in some new fixtures for two reasons. First, we want to be above average. Second, we plan on keeping these properties for 50, 75, 100 years, right? So we want to minimize the amount of maintenance calls, of issues. We want to make things a lot easier to turn, right? So it's easier to turn the vinyl planks than it is carpet. So we would rather pull up carpet and put down vinyl planks. We upgrade plumbing, electric, ductwork, furnaces, all that stuff as needed. And before we rent out a property, we try to make sure that everything has a decent amount of longevity left in it before we rent it out. But depending on a wide array of variables, that rent ready range can drastically differ. One thing that we have done a couple of times at the recommendation and request of the people is to offer kind of like we kind of call it the bargain bin, right? So kind of like Runner Gunner was talking about, we've had some properties that, we have some people that want to rent out properties for $600, $700 a month. Well, we can do that if we don't make any updates. If you don't mind some older kitchen cabinets, if you don't mind, an older bathroom, if you don't mind some older flooring, then we could rent you a property for $600 per month. So on a couple of times we have rented those out. It's not our MO, but as people request properties that fit the screening, that have applied for other properties and have expressed interest to us that they want a cheaper property, then we will definitely run them by a property before we go do any major renovations if they're in the area looking for a cheaper place. I was just watching your foreclosure video, still relevant for today. Absolutely. The government's not exactly known for making changes. And, during this past 2 years, that's no exception. Everything that I said in that foreclosure video in 2020 is still spot on accurate. I highly recommend it still for anybody looking to invest in foreclosures. In fact, I would say that I'm willing to wager that video will be spot on accurate and very relevant for the next couple of decades, because what was true about foreclosures 10 years ago is still true about foreclosures today. The foreclosure process is one that spans all the way back to the original deed of a property, the original mortgage. It's pretty set in stone. That's why banks offer such low interest rates on real estate, is because it's time tested and proven, and the legal process is a firm one. Random question, but have you ever played Catan? I feel like you would be good at that board game. Yes. My wife and I play a lot of that. We did. We did. When we had 2 kids or less, we played Catan a lot more frequently than we do now with 4, almost 5 kids. But when we're on vacation, we definitely play a time or two. What's up, man? Great seeing you today. I appreciate you coming back out. Another crazy thing to look at is this. Oh, the bond rate might hit 10% in May. Yeah, that's crazy. I don't really. My brother keeps up with that. My brother is. Without him, we would have a very lopsided business. He has learned so much about finance. Yeah, he's in the thick of it, and the bond rates are one of the things that he looks at a lot. Should I buy a property through an LLC if I plan to rent it out? That is a loaded question. So the way that you worded it isn't quite relevant. You can rent out a property if it's in an LLC. You can rent out a property if it's in your personal name. The thing, in my opinion, that determines whether or not you want to put it in an LLC or not is how you plan to refinance it. If you are buying a property and you plan on using a Fannie Freddie loan, if you want that 30-year lowest interest rate deal, then you should keep it in your personal name. Because when you go to the underwriter bank, then the bank is not going to want to give you a Fannie Freddie loan in the name of an LLC. It's going to have to be in your personal name, and they're going to qualify you for that loan based on all your personal information. If you are paying cash for that property and when you do refinance it, you're going to use a commercial loan, which is probably going to be 20, 25 years at a higher interest rate than is what is available to you from a Fannie Freddie rate, then it's okay. You can put that property in an LLC. And then to kind of go one step beyond that, I would say for most new investors, that is the most important thing, is how you plan on refinancing that property. If you want to take advantage of the lowest interest rates for the longest term, then it should be in your personal name. If you are going to immediately go over to the commercial side and stay there, and if you don't care about getting the lowest interest rates or the longest terms, then the commercial side is fine for you, and putting it in an LLC is also fine. From there to go beyond that, risk tolerance is really what it comes down to. So I know people that have hundreds of properties in one LLC. I know people that have one property per LLC. I know some people that have around 100 properties in their personal name. It's really up to you and what you can do to help you sleep best at night. The gentleman that has around 100 properties in his personal name, he does the majority of work himself. He's not quite worried about insurance either. It's a really cool, very squared away, awesome individual. The person that I know that has one property per LLC, to top that off, they've got a separate land. What is it called? Land trust. They have a separate land trust for each property. And that land trust has a different LLC per property as the beneficiary. Hands down, one of the most paranoid people I've ever met. When I was with that individual, we were in a public place. We were in an eating establishment, and she kept asking me to lower my voice. So didn't want people around us to hear what we were talking about. Obviously, as I'm sitting here telling you about everything that I'm doing in as much detail as people ask on the World Wide Web, available for anyone to view, I'm not wired that way. I don't mind if people hear what I'm saying. Very interesting times. 12 people on. Post your questions on the chat. Let's see here. Anything that you have to say? I've gone on some tangents. See this beautiful couch behind me? My office is coming together. I'm pretty proud of it. I'm going to put something over there in that corner. There's a lot of space over there. I think right over here in this little nook next to the fireplace, I've got a bookshelf, that one that used to be behind me in the videos, the one that lights up. I'm going to put that over there, I think. I'm not quite sure what our plans with that fireplace are yet. But I think we're gonna cover it in something. I don't think we're gonna keep that existing brick exposed. I think we're gonna put a nice little mantle over there. And above the mantle, that's probably where I'm gonna put those little Scrabble letters that say wisdom. Pretty excited about that. That little tiny cabinet, that was something that was here in the office when we purchased it. There was a lot of cool old furniture. It was vacant for, I think, about 15 to 20 years. So the furniture was pretty dusty, and it had been broken. This place has been broken into several times beforehand. So some things were pretty beat up. Not much was salvageable, but some was salvageable. That's one of them. I may come into my property significant under market value through my parents buying a new home. That sounds solid. Thank them for that equity that they're handing over to you. That's very nice of them. How many houses should I buy before quitting my job and doing real estate full time? I have no idea. That number is different for everybody. I recently did a podcast and somebody tried to tell me that one of their friends has 3 properties and quit his job and did it full time. I have no idea how they're making that work. Surely they're in for a rude awakening. I think what you should do is before you even entertain the idea of leaving your job, you should fully take advantage of as many Fannie Freddie loans as you can qualify for on your W-2. Because as soon as you quit your W-2 job, your bankability pretty much stops for about 2 years. Now, if you're able to build a sizable real estate portfolio for longer than 2 years, you might be able to transition a little bit, a little bit easier. Maybe that's what I would recommend. But you can go a pretty far way before you quit your job. A good friend of mine has, I think, like 60 doors, and he still works his full-time job. We didn't start paying ourselves until like late last year when we had close to 200 doors. And even then, we didn't pay ourselves like a full-time wage. Arguably, we don't really pay ourselves a full-time wage right now, I think the answer to that question is so much deeper than how many properties does it take to replace my personal income, right? There's a lot of strategy, potential, opportunity, preference, and long-term goals that go into that. I'm trying to think about the most number of doors that I've heard someone have and still work their full-time job. I think it was 800, but he was also a syndicator, so it's not necessarily like a fair assessment because while he technically owned part of 800 doors, he had like a small ownership, like 5% or less in those 800 doors. So it's not necessarily a tick for tack. I have a client that wants to get a personal loan, about $40K, and pull the cash to buy a fixer-upper property, cash, and rent it out. Have you ever done this? Not sure if that works. dude, you've been on my mind to call you for quite some time. I'm going to do that today. Yeah, no, I think that's a really good idea. I know a lot of people that either buy properties using personal loans to buy a property free and clear. I know people that have used credit cards to buy properties, home equity lines of credit. So long as you are making money at a higher interest rate than you're borrowing, chances are it's a good deal. If you are using a credit card to like acquire and fix up a home before you refinance it with a traditional bank, then I think that's probably a good idea too, right? Because then you're saving yourself the origination fees that a hard money lender would charge. I don't think it's a bad idea at all. Yeah, we've used credit cards, we've used lines of credit, we've used personal loans. We've done it all, I think. I think it's a good idea. How old were you when you bought your first property, and how long did it take you to have 10 properties? So the numbers are fresh because I went through it earlier on the call. So 2017, I guess I was 28. August of 2017, I bought my first property. It was a duplex. We ended 2017 with 2 doors. The following year, we closed on a package of 13 properties in December. So in 2018, we ended the year with 21 doors. 2019, we ended the year with 38 doors. 2020, we ended the year with either 80 or 84 doors. 2021, we ended with 200, and hopefully we're going to end the year around 400. So 2017, when we purchased that first duplex, we did so in cash. We bought it for $35,000, and I did that in cash, in my own cash. So before that, I got my first job in law enforcement when I was 21. I used the police academy as elective credits to finish out my undergrad. So I was a college kid getting a full-time job paycheck. Granted, when I was hired, I was only making like $33,000 a year. And then after I finished training, like 6 months later, I think it bumped up to like 38. And then when I left in 2017, in April 2017, I think I was making about 44 grand per year. But because I was a college kid, I saved. So from the time I was hired, I saved 50% of my paycheck per period. So when I left in 2017, I had right around 100 grand saved up. So when I bought my first property in 2017, I also had like 100 grand. I surrendered all of my retirement plans, all my savings. I currently have no money in the stock market. I currently have no money in retirement. I am all in 100% real estate. I messed around with crypto for a while, and I recently cashed out all of that and put it into real estate. A real one-trick pony I am. So even though I started in those first 8 properties that we purchased, my brother and I did a lot on our own accord with our own capital. We got our private investor, I think around our 6th or 7th property, and our first private lender was $26,000. Was the loan amount of that one. And then we used a little bit of seller financing. I think on like property 8, we used some seller financing, and then that package of 13 that we closed in December was seller financed. So while I was 28 when I started, a lot of people when they're starting don't necessarily have 100 grand yet. So if you look at from a frugal like money management perspective, technically I started when I was 21, which allowed me to jumpstart the real estate whenever I set my mind to it. Dude, I appreciate you calling me king. You have a great Friday too, man. There's a guy on YouTube called Value Select, and the title of the video is "Send This to a Fellow King." You should check it out. It's one of my favorites. I like to randomly text that to people. Such a good, wholesome video. Oh, look at that! I already answered that question before I got to it. Coming from the Dave Ramsey School of Finance, would you suggest that an individual eliminate all or majority of personal debt before investing in real estate? Maybe, and that's, I came from the Dave Ramsey School of Thought as well. So when I first started, I had no personal debt and 100 grand. I was very intentional about paying all my debt when I was like 23 or 24. But I'm not going to say coached, but I have talked to several people with student loans and whatnot, and I highly recommend that they go ahead and start investing rather than pay off their loans. And I think it really comes down to the interest rate and the payment, right? So like, let's say you have $50,000 worth of student debt and it's at 5%. And your payment is, I don't know, $50 per month. Then if you had $50,000 in your bank account, would spending it to save $50 per month be the appropriate thing to do? Probably not, because if you invest that with a local real estate investor at like a 10%, 12% interest only, then that same money, that $50,000 would make you $500 per month, right? So in that case, it makes more sense for you to do an investment, given the ability to have a lump sum of $50,000 and invest it, and then use some of the proceeds from your investment, the interest only payment, to pay off the student loan debt, right? So now on your balance sheet, you're gonna even those out. So technically your net worth is zero. If you've got $50,000 in student debt, a lump sum of $50,000 that you now invested in a promissory note or a first position mortgage, and your income offsets your income from the promissory note, offsets the amount that your student loan payment is, right? Like that is the appropriate way to do it, in my opinion. So if real estate helps you do that, then I think that's the right answer. Now, if you've got like a 22% credit card with 5 grand on it, you're going to be hard pressed to make greater than 22% with 5 grand. So in that circumstance, I think it makes most sense to pay off that credit card debt. Now, even if your credit card is at like 5%, but you have so totally wholehearted bought into the Dave Ramsey school of thought of debt is the devil and all of it is evil, and you have a difficult time sleeping because of that, then it is 100% in your best interest to go ahead and pay that off, regardless of what the math on that like interest game is, right? Because nothing is worth your quality of life or your ability to sleep through the night, right? You should protect that at all costs, because as soon as you sacrifice that, you immediately become a less of a quality person. We're kind of built dependent on sleep and not being overly stressed. So protect that 100%. I would say that when I bought my first property, I had every intention of doing so on a pure cash basis. I had no interest in taking out loans on properties. That's why I bought my first duplex in cash. We had 35 grand. I spent 35 grand to buy that. It was rented for about $1,000 per month. However, I had a bad property management company. That company nickel and dimed us, even though it was bringing in $1,000 per month. I would say At the end of the month, on average, I would get about $150 to $300, never as much as I should have or would have expected to. Now, the second deal that I ever purchased, I did so for $28,000. It was a recently renovated home. It needed no work, it had no deferred maintenance. I did not have $28,000 to spend on that comfortably, right? So I'm trying to think why I didn't, and I just remembered why. So also when I first started, when I wasn't too confident on the real estate side of things yet, I did make some hard money loans or private money loans to other people. So I had about, I think, $45 to $50,000 out to other investors before I was confident in what I was doing myself. So there was that time where, because I just told you I started with 100 grand, and that's true, but I only spent 35 on that duplex. That's where the rest of my cash was. I kind of forgot about that stage of my investing career. So at the time, I didn't have $28,000 to take that deal down without like cutting into our personal stuff. So what I did there was I used debt because I felt like it was too good of a deal. I really wanted that property. And when I took my wife to it, we determined that we would live there ourselves. We would happily raise some kids there. It was a really good deal. Didn't want to pass up. So I ended up taking out a loan. Like I got a Fannie Freddie loan for that house. So the purchase price was $28,000. We put $7,000 down. That was a 25% down payment. I think closing costs were like right at like $2,500. It was about 10% of the purchase price, which is why most banks don't want to do these lower loans, is because there are fixed costs associated with closing a property, the appraisals, all of that make closing costs pretty high when it comes to lower valued homes like that. So all in, our cash out of pocket was like $9 grand. The mortgage payment on that $21,000 loan was $112.73 per month. So that is when, I like things really clicked for me. And I thought to myself, we rented this property out for $770 per month. Our mortgage payment is $112.73 per month. How many times can I do that before it's not worth it, right? 100 times, 200 times, 300 times? The answer that I came to was there is no limit on how many times I can do that where it doesn't make sense. The returns were infinitely greater than me deploying $35,000 worth of my own cash to get a return of less than $1,000 per month after the management fees and all that. So from that perspective, that's when I completely changed my mind about leverage against income producing assets. Really long answer to answer your question. Hope it was helpful. Not in an arrogant way, but I think that might be a good short video. I don't think I left any stone unturned. I appreciate your insights and your sharing with them, Ryan. I appreciate you. I've never seen your name on here before, so thanks for joining us. Really appreciate it. T-Pal, what up? Thanks for your input. I appreciate it. Let's see here. How do you feel about the notion of only investing in areas relatively close to your home? I don't know who has that notion. I don't really care one way or another, the proximity to your house. I'm in the process of moving to the area that I invest in. So it's really important to me because, I plan on spending the rest of my life making this area as nice as possible. And I really love the community, the area, the city. So I'm all in. Being an out-of-state investor, I don't really have a problem with it. I know the most successful ones that I know regularly come out to the area. And every time I have known an out of state investor to not frequent the area at one point or another, they get straight wrecked by contractors, by residents. Um, I'm sure I've heard that Dayton is extraordinarily and unusually difficult to find good, reliable property management and contractors in, since this is the only area I've invested in at any scale. I would say I don't know the answer to that. I would say I don't know how it stacks up against other places, but just from the insurance agency side of things, I've seen some people do pretty well, but they frequent the area. Um, Seen a lot of people get wrecked. I have watched a lot of people come in and then sell their portfolios. I have purchased several homes from insurance clients that decided that they're no longer interested in investing in the area. Always tragic. So I would say that the success rate becomes higher the closer that you are to the properties. But I've also bought just as many, if not more, properties. Actually, I've easily bought more properties from people that live closer to their properties and are tired of them. So I'm going to go back on my whole statement. I have no knowledge as to the proximity of your homes and the potential success rate as an investor. I caught myself saying things that I couldn't substantiate. My apologies. Ooh, ooh, yikes. I'm from Dayton, LOL. I live in Atlanta now. Come on back. Dayton is a fantastic spot. You should come back. You should come back real quick. You should come back and you should help. Dayton needs a lot of help. Your hometown needs you. They've got like 10,000 vacant homes, many of which you probably have very good memories. Once thriving areas that were probably quintessential to your childhood, now in disrepair. Come on back. Be part of the movement. Help bring life back into this. In fact, grab 5 of your closest friends in Atlanta. Tell your employer to move here. Tell them you'll help grow an arm of their business out of Dayton. I think there are like 10,000 vacant homes in the area. I read this article just to help motivate you. I read this article this morning on Dayton Daily News, and it was very frustrating to me. I told myself I wasn't going to mention this article on the live stream, but here we are. Let's see if I can log in and find it. I had a long conversation with the city recently because the city owns a significant amount of real estate in the area, and they have no way to sell the property that they own. And they aren't doing anything with this property except paying people to mow it. I can't get Dayton Daily News to load. Anyway, the city is not helping itself. The city can't get out of its own way. And this article, somebody was saying that the affordable housing situation inside of Dayton was a very complicated one. It is not complicated. I think one of the things that the article did as well was it made complaints about the older housing stock and said something like 50% of the houses or 70% of the houses, something that doesn't matter, is like older than 50 years old. And it's just like, you cannot possibly convince me, as someone who has now renovated, over 100 of these homes inside of the city limits of Dayton that are 100 or more years old, you can't possibly convince me that something built nowadays is half as structurally solid, as sound, is as durable or sustainable as some of the homes that were built, if not all of the homes built during the 20s and 30s here in the area. The housing stock is old, but it could not be of higher quality. You've got properties that are sitting around here vacant that have had holes in the roof for 10 plus years that have not yet been structurally compromised. You've got the city constantly tearing down homes that are salvageable. You've got a extraordinary mismanagement of resources and funds that are further degrading the city, right? It's not a difficult situation at all. Get in here and fix these homes, right? It's as simple as that. There's nothing wrong with the existing housing stock. These things are gorgeous once they're done. Another thing is that's pretty unique to the Midwest, I think, is whenever the economy was thriving back in this area. I mean, you've got massive 1,800, 2,500 square foot homes all through the city where the rebuild costs of these things, if you were to build them new, are like with the like materials are like $300,000, $400,000, and it will not cost that much to renovate them. All the bones are good. You've got a lot of the older properties once you get into some of the nicer areas that have like the foundation is made of like of limestone, like 600 pounds per block, massive limestones. Those houses aren't going anywhere. We bought a house that was built in 1885. I've got one under contract right now. It was built in 1850. There's nothing wrong with this house. That 1885 home is one of the most solid homes that I have ever been in. I had three of my kids with me. I had them jumping on like the second floor. I was in another room, could not feel them jump, could not really hear them jumping, right? It's a brick and block house, that limestone foundation. The joists are closer than what modern code allows for. You've got the X bracing between each of the joists in way more frequently than modern code calls for. So don't act like the age of the homes has anything to do with the viability or salvageability of Dayton's housing stock. But who am I? Little old Ryan Ingram with a probably highly faulty, inexperienced opinion. All right, I went on that long rant that was completely useless without getting any more questions. It is 9:42, and I think we've got 10 people on. Been doing this for an hour and 42 minutes. I think we're probably going to be good to go. Hey, I'm happy to hear that you're moving back to Dayton. Really looking forward to meeting you. Before this live stream, actually, every Friday morning we do a in-person meeting of a bunch of real estate investors here in the area. It's at 6 a.m. It's at my office. You are more than welcome to join whenever you move up here. And again, bring 5 to 10 of your closest Atlanta friends and at least half of the businesses that they work for. And hey, you'll be greatly appreciated. All righty. Well, hey, next Friday, 8 a.m. Eastern Standard Time, I will be right here. I think this setup is awesome. I'm a huge fan. I'm happy to hear that there is no echo. So at least that's what my mom says. I believe you, Mom. Next week, bring all your questions. Talk to you then.